Yesterday, the Securities and Exchange Commission made formal charges against the CEO of China MediaExpress. This was one of the companies that kicked off the distrust in all Chinese-owned companies that are listed on the American stock exchanges. China MediaExpress was one of the really bad companies that was caught in bad accounting and fraudulent statements. The whole episode against China MediaExpress began a couple years ago. The investigation against China MediaExpress has come down to charging its chief executive officer, Zheng Cheng, with fraudulently misleading investors after a long process that took the company off the Nasdaq board in May of 2011 and then deregistered the securities in March of 2012.
Thursday, the SEC published their findings against China MediaExpress and its chairman and CEO. The history included a reverse merger entry to be publicly traded. That was followed with false reports of business increases, fake profit statements, and reports of company financial condition that had little truth in them. The SEC said China MediaExpress falsely claimed in its 2009 annual report that it had $57 million in cash on hand when it only had a cash balance of $141,000. It also misrepresented its cash balances in press releases as well. After it misrepresented its financial condition, the SEC said the stock price tripled to more than $20 a share. The company's auditor resigned in March of 2011. The SEC said that Zheng tried to bribe the accountant handling the probe with $1.5 million, but the accountant refused. Nasdaq delisted the company's stock in May of 2011. The SEC deregistered its securities in March of 2012. The report from Reuters news agency said that this China MediaExpress case is the latest in a long-running crackdown by the SEC into accounting fraud at China-based companies that are listed on U.S. stock exchanges. Often the companies listed through reverse mergers with dormant shell companies. Accounting scandals at many of these companies have prompted auditor resignations and have led the SEC to launch investigations into the companies, their executives, and their auditors. To date, the SEC said its cross-border working group has filed more than 65 fraud cases against companies or executives and deregistered the securities of more than 50 companies.
The SEC in December charged the Chinese affiliates of Deloitte, KPMG, PricewaterhouseCoopers, BDO, and Ernst & Young with violating the law by refusing to hand over documents to aid the agency's investigations. That case is still pending, and a hearing in the SEC's administrative court on the matter is slated for July 8th. The accounting firms have not complied because they say that would violate the Chinese laws of corporate privacy and the kind of transparency that the SEC needs for companies listed on the U.S. exchanges is not the same level of open financial reporting. China does not require that level of financial reporting right now, but reforms are being made to put Chinese public accounting in line with other exchanges around the world.